I have chosen to do my project on the Walt Disney Company. The Walt Disney Company is the market leader in the mass media entertainment industry, with business segments in media networks, parks, experiences and products, studio entertainment, and direct-to-consumer and international entertainment. We will start by looking at the balance sheet. In terms of assets, the company has total assets of $98,598 million, made up of $52,832 million in equity. The income statement shows net earnings of $12,598 million, with earnings per share of $8.40 for basic and $8.36 diluted. The cash flow statement reflects an ending cash balance, cash equivalents, and restricted cash of $4,155 million. So looking at time value of money, Disney must determine the amount they must contribute every year to meet their obligations for pension funds and post-retirement medical plans. They use time value of money to make those calculations and use some key assumptions for that. This is very important because a 1 percentage point decrease in the assumed discount rate would increase total benefit expense for the fiscal year by approximately $241 million and would increase the projected benefit obligation by approximately $2.7 billion. And a 1 percentage point increase in the assumed discount rate would decrease total benefit expense and the projected benefit obligation by approximately $229 million and $2.3 billion, respectively. Cash and cash receivables. Disney's cash and cash equivalents consist of cash on hand and marketable securities, and restricted cash consists of cash posted as collateral for certain derivative instruments. The data points reflect a decrease from 2016 to 2017, with a slight increase from 2017 to 2018. We can also look at free cash flow by analyzing the cash provided by operations, capital expenditures, dividends paid, to determine that free cash flow has been increasing over the last few years. In terms of receivables, the company uses the allowance method for doubtful accounts, and here we can see the amount that they allocate to the allowance for doubtful accounts is $192 million. Valuation of inventories. So inventory primarily includes vacation timeshares, merchandise, food materials supply, and carrying amounts of vacation ownership units are recorded at the lower of cost or net realizable value, and while carrying amounts of merchandise, food materials, and supplies are generally determined on a moving average cost basis and are recorded at the lower of cost or net realizable value. Here we can see that the sale of consumer products is a relatively small portion of Disney's operations, as inventory is only 1.4% of total assets. For additional valuation of inventories, I took a look at the inventory turnover. And here we can see that their inventory turnover has increased from 21.5 in 2016 to 23.5 in 2018, and it's actually above the industry average of 15.9. Parks, resorts, and other property are also known as property, plant, and equipment, and they summarize attractions, buildings, equipment, and land, which actually makes up 30% of Disney's total assets. These assets are actually carried at historical cost, and depreciation is computed using the straight line method, generally over estimated useful lives. As we can see here, there's 4 different categories for the estimated useful lives of the assets. Disney's attractions, building, and equipment originally cost $55,238 million. However, the company has already recorded $30,764 million in depreciation. Disney has a rich portfolio of intangibles, and the largest portion of those intangibles are made up by goodwill at $31,269 million, while copyrights patents make up $6,812 million. These are some of the key highlights found on the Walt Disney Company's financial statements. Thank you.